Hey guys, so let's talk about something every dividend investor dreams about, earning $1,000 a month in passive income. The idea sounds simple, right? Just invest, sit back, and watch the cash flow in every month. But the real question is, how much do you actually need to invest to make that happen? Specifically using one of the most talked about dividend ETFs in America right now, SCHD. The Schwab U.S. Dividend Equity ETF. Now, before we jump into the math, let's make sure we're all on the same page about what SCHD actually is. SCHD isn't just another random fund on the market. It's one of those ETFs that's built around quality companies, quality balance sheets, and a consistent record of paying and growing dividends. This ETF was launched by Charles Schwab, and over the years, it has become a top choice for investors who want a balance between solid dividend yield and long-term price growth. When you buy SCHD, you're not buying just one company. You're buying a basket of large, established U.S. companies known for reliability and profitability. We're talking about businesses like Broadcom, Cisco, PepsiCo, Coca-Cola, and Verizon, the kind of names that have been around for decades and are still producing strong cash flow. That's what gives SCHD its stability and its reputation for being one of the best dividend ETFs for passive income. Now let's take a look at where SCHD stands in 2025. As of October 2025, SCHD is trading around $26.79 per share. Its dividend yield is hovering near 3.8 to 3.9% depending on the day you check. That yield is calculated based on the fund's annual dividend payouts divided by its current share price. If you hold SCHD, you receive quarterly dividend payments, meaning you'll get paid 4 times a year. Currently, each quarterly dividend is roughly 26 cents per share, which brings the annual payout close to $1.03 per share. That means for every single SCHD share you hold, you can expect to receive just over $1 each year in dividend income, assuming the current rate continues. Now remember, that number can go up or down over time, because dividends are never guaranteed. But SCHD's strength is in its consistency. Its managers follow a strict methodology that focuses on companies with a proven track record of paying reliable dividends year after year. In other words, SCHD isn't chasing the highest yields, it's chasing sustainable yields from high-quality businesses. So here's the big question. If SCHD pays roughly $1.03 per share per year and you want to earn $12,000 per year in dividends, that's $1,000 per month. How much do you actually need to invest? Let's do the simple math together. $12,000 per year divided by 0.0386, which is 3.86%, equals around $310,000. That's the total value of investment you'd need in SCHD to produce about $12,000 a year in dividend income at the current yield. Now if we break that down further based on the current price per share, which is $26.79, $310,000 divided by 26.79 gives us roughly 11,575 shares. So yes, to make around $1,000 a month in dividend income from SCHD, you'd need to own approximately 11,600 shares, assuming the yield and price remain stable. And that right there is the magic number. But of course it's not that simple, because in real life markets move, prices go up and down, dividends fluctuate, inflation eats into your buying power, taxes play their part too. So even though the math looks straightforward, there's always a little bit of wiggle room that you need to factor in. Still, this calculation gives you a realistic ballpark idea of what it would take to generate that kind of monthly income from SCHD in today's market. It's not an impossible target, but it does require patience, consistency, and the willingness to reinvest your dividends until the compounding starts working in your favor. Let's pause here for a second and think about what that $310,000 actually represents. It's a large sum, no doubt. But the beauty of dividend investing, and especially with an ETF like SCHD, is that you don't have to get there overnight. You can build your position gradually, one paycheck at a time, one dividend reinvestment at a time. Over years, that snowball effect can be massive. And here's where SCHD really stands out compared to other high-yield ETFs. Many funds chase higher yields, 6%, 8%, sometimes even more, but those often come with higher risk or inconsistent payouts. SCHD focuses on total return, meaning it balances steady dividends with long-term capital appreciation. Historically, that's been a winning combination. Think about it this way. If SCHD's yield is around 4% and over the long term, it also grows its dividend by 6 or 7% annually, your income stream grows faster than inflation, and your portfolio value can rise as well. That's the double benefit of dividend growth investing. You're not just living off fixed payments, you're building a growing cash flow. Now, let's dig a bit deeper into how those dividends actually get paid out. SCHD distributes its dividends quarterly, typically in March, June, September, and December. Each payout can vary slightly depending on the performance of the underlying companies and any portfolio rebalancing. So, while you might not receive exactly $250 every single month, the quarterly checks average out to about $3,000 each if you hold enough shares to hit that $1,000 a month mark. For investors who prefer a more consistent cash flow, some people pair SCHD with other ETFs or individual dividend stocks that pay on alternate months. That way, they smooth out the timing of payments throughout the year. But even with just SCHD, the quarterly schedule works fine for most long-term investors, especially those who simply reinvest dividends automatically through their broker. Reinvestment is the secret sauce here. Instead of taking those dividends out as cash, if you use them to buy more SCHD shares, your next dividend payment will be slightly larger, and the one after that even larger. It's the compounding effect in action, and over a decade or two, that can transform your income stream dramatically. Let's look at a practical example. Suppose you start today with $100,000 invested in SCHD. At the current yield of around 3.86%, that's $3,800 per year in dividend income. If you reinvest that income each quarter, assuming the yield stays constant and the fund appreciates at a modest 5% per year, in 10 years, your investment could grow to roughly $160,000. At that point, your annual dividend income would rise to more than $6,000 without adding a single extra penny of new money. That's the power of compounding. Now imagine if you were able to keep adding a few $100s every month on top of that, your path to $1,000 a month in dividends suddenly becomes a lot more achievable. This is the approach many smart U.S. investors take. They treat SCHD not just as a source of income today, but as a wealth-building tool for the future. It's also important to remember that SCHD has a low expense ratio, just 0.06%, which means you're not losing a big chunk of your returns to management fees. For every $10,000 invested, the annual cost is only about $6. That's extremely competitive compared to many actively managed funds, and it's one of the reasons why long-term investors love ETFs like SCHD. Another thing that sets SCHD apart is its dividend growth record. Over the past decade, SCHD's dividend per share has roughly doubled, growing at an average rate of about 12% per year between 2013 and 2023. Even if that growth slows down in the future, say to 6 or 7%, it's still enough to help your income rise faster than inflation, which is crucial if you're planning to live off dividends someday. But before you start dreaming about quitting your job on SCHD income alone, it's essential to set realistic expectations. Market cycles happen. Companies can cut dividends. And while SCHD's portfolio is full of blue-chip names, it's not immune to downturns. For example, during the 2022-2023 rate hike cycle, SCHD's price dropped from around $75 to under $30 due to broad market corrections and yield adjustments. That's a reminder that even safe dividend ETFs can be volatile in the short term. However, For long-term investors who keep reinvesting and holding through volatility, these dips often present buying opportunities. Every time the price dips but the underlying dividends remain steady, your reinvested dollars buy you more shares, which in turn boosts your future income. That's why experienced dividend investors often say, "Don't fear the dip, feed the dip." So, to summarize this first part of our journey toward earning $1,000 per month with SCHD, here's what we've covered so far through the conversation. SCHD is one of the most reliable dividend ETFs in the market today, with a solid yield of around 3.8 to 3.9% in 2025, trading near $27 per share. To make around $1,000 per month in dividends, you'd need about $310,000 invested, which equals roughly 11,600 shares. But the most important takeaway is this: you don't need to reach that goal immediately. Start small, stay consistent, reinvest your dividends, and let time and compounding do their job. SCHD rewards patience. It's not a get-rich-quick play. It's a get-rich-steadily strategy. So now that we understand the basic math behind making $1,000 per month from SCHD, let's go a little deeper into the reality behind those numbers. Because on paper, everything looks clean and predictable. You invest $310,000. You collect about $12,000 a year and you're done. But in real life, investing never happens in a straight line. The market moves, companies change, yields fluctuate, and taxes always show up at the party. That's why understanding the risks, the taxes, and the strategy behind this plan is just as important as knowing the math. Let's start with the biggest one: risk. When people hear the word risk, they often imagine losing money overnight. And yes, price volatility is one kind of risk, but in dividend investing, there are a few different kinds of risks that matter more. One of them is dividend sustainability. In other words, whether the companies inside SCHD can continue paying and growing their dividends year after year. Now, SCHD is built around what's called a quality screen. It focuses on U.S. companies with strong fundamentals, consistent cash flow, solid balance sheets, and a history of raising dividends. That's one of the reasons this ETF is trusted by so many long-term investors. But even the strongest companies can face challenges. Economic slowdowns, changing interest rates, or corporate restructuring can all lead to dividend cuts. For example, think back to 2020 when the pandemic hit. Many companies temporarily suspended or reduced their dividends to conserve cash. SCHD handled that period better than most dividend ETFs because it's diversified and holds many stable businesses, but it still experienced short-term yield pressure. The takeaway here is simple. No dividend is ever completely risk-free. The second kind of risk is price volatility. Even though SCHD focuses on large blue-chip companies, its share price still moves with the overall market. If interest rates go up, dividend-paying stocks often fall because new bonds start offering higher yields. That's exactly what we saw in the 2022-2023 period, when SCHD's price declined significantly from the $70 range to under $30. Investors who panicked and sold at that time took losses, but those who held or reinvested during the dip saw their future yields rise. And that's the key mindset behind dividend investing. You're not buying shares to trade them every week. You're buying cash flow producing assets that pay you regularly. When prices drop but dividends stay consistent, it's actually an opportunity, because those same dividends can buy more shares at a cheaper price. That means more future income. It's the same principle as dollar cost averaging, just powered by your dividends. Now let's move to another reality most people forget about: taxes. When you receive dividends from SCHD, the IRS wants its share. But how much you owe depends on what kind of account you hold it in. If you own SCHD inside a tax-advantaged account like a Roth IRA, your dividends can grow and compound tax-free. That's one of the best places to hold dividend ETFs if your goal is long-term passive income in retirement. If you're holding SCHD in a traditional brokerage account, the dividends are considered taxable income. But here's the good news. Most of SCHD's dividends qualify for the lower qualified dividend tax rate, which ranges from 0 to 20% depending on your income bracket. So it's typically taxed more favorably than regular wages or interest income. Still, it's important to plan for it. Let's say you earn $12,000 in dividends in a year from SCHD. If you fall in the 15% qualified dividend bracket, that's $1,800 in taxes. Your actual take-home passive income would be about $10,200. It's still great, but it's not exactly a full $1,000 per month after taxes. That's why many investors aim for a slightly higher target, maybe $13,000 or $14,000 in annual dividend income, to leave a cushion for taxes and inflation. And if you're investing for retirement, using a tax-advantaged account can make a massive difference in how fast your income compounds. Speaking of compounding, let's talk about one of the most underrated forces in investing: dividend growth. SCHD's average annual dividend growth rate over the past 10 years has been about 12%. That means if it keeps growing its dividends even at a slower rate, say 5 or 6% per year, your income could double roughly every 12 years without you adding any extra money. That's the power of reinvesting and staying consistent. Let's take a simple example. Suppose you invested $200,000 in SCHD today. At a yield of 3.86%, that's $7,700 in annual income. Now let's assume SCHD continues to grow its dividend by 6% per year. In 10 years, your annual income would rise to almost $14,000, even if the price stayed exactly the same. That's nearly double your original income, purely from dividend growth. No extra contributions required. This is what makes SCHD such a strong candidate for long-term investors. It's not just about yield, it's about yield plus growth. The twin engines of income compounding. Yield gives you cash flow today, and growth gives you purchasing power tomorrow. Together they form the foundation of real passive income. Of course, dividend growth doesn't happen in a straight line either. Some years SCHD's dividend might jump by 10%, other years by only 2 or 3. What matters is the overall upward trend. Over time, as long as the fund continues selecting financially strong companies, the dividends should rise steadily. Now let's talk about yield fluctuations. A lot of investors get confused when they see SCHD's yield changing every few months. They think the fund is paying more or less. But remember, yield is just a ratio. It's the annual dividend divided by the share price. If the price of SCHD rises, the yield looks smaller, even if the dividend stays the same. And if the price falls, the yield looks larger. That's why you shouldn't chase yield. You should focus on consistent income growth. Imagine this. SCHD pays around $1.03 per share annually. If the price goes up to $30, the yield drops to about 3.4%. If the price falls to $25, the yield jumps to about 4.1%. But in both cases, you're still getting the same $1.03 per share in cash. The yield percentage just looks different because the price moved. That's why experienced dividend investors care more about the dollars coming in than the yield number flashing on the screen. The yield helps you estimate your returns, but the actual dividend amount is what matters to your bank account. Now let's address another important piece: diversification. SCHD is excellent, but even the best ETF shouldn't be your only source of passive income. Think of SCHD as your anchor, the steady foundation of your income portfolio. Around it, you can build layers of diversification to make your cash flow smoother and more reliable. For example, SCHD pays dividends quarterly. That means you'll receive payments in March, June, September, and December. But what about the other months? You can pair SCHD with another ETF, like VYM or DGRO, which have slightly different payout schedules. Some investors even combine U.S. dividend ETFs with international ones like VX-US or VYMI to get exposure to global companies. By blending different funds, You can essentially create a portfolio that pays dividends almost every month. It doesn't change the total amount of money you receive over the year, but it smooths out the timing, which can be really helpful if you're using dividends to cover living expenses. Another layer of diversification comes from including some higher yield assets for balance. For example, real estate investment trusts, REITs, or covered call ETFs can offer higher income streams, though they come with their own set of risks. The key is balance. Enough SCHD for stability and growth, enough other income sources to maintain monthly consistency. But remember, more yield doesn't always mean more safety. It's easy to get tempted by ETFs offering 8 or 9% yields, but those often sacrifice long-term growth and can cut dividends during downturns. SCHD's moderate yield is part of what makes it sustainable. It's not trying to overpay, it's trying to last. Let's also talk briefly about inflation. If you're aiming for $1,000 per month in income today, keep in mind that in 10 years, that $1,000 won't buy the same things it does now. Historically, inflation in the U.S. averages around 2 to 3% per year, though it's been higher recently. The good news is that SCHD's dividend growth has historically outpaced inflation. So as long as it continues increasing payouts over time, your income's purchasing power should stay strong. Now here's a realistic way to approach this entire plan. You don't have to wait until you have $300,000 sitting around. Start with what you can. Maybe $5,000, $10,000, whatever amount you can invest consistently. Set up automatic contributions every month, reinvest your dividends, and don't panic when the price drops. That's when your reinvested dividends are buying more shares at a discount. Over 5 to 10 years, you'll be amazed at how much those small contributions and reinvested dividends add up. It's not about timing the market. It's about time in the market. SCHD rewards those who stay invested long enough to let compounding work its magic. Let's consider a quick hypothetical. If you invested $500 a month into SCHD for 20 years, assuming an average annual return of 8% including dividends, you'd end up with around $275,000. At a yield of 3.8%, that portfolio would generate about $10,400 in annual dividends. That's almost $900 a month in passive income. And that's without any massive lump sum investment. That's the power of consistency. It's also worth noting that SCHD's underlying companies often raise dividends even during tough times. Take companies like PepsiCo or Coca-Cola. They've been paying dividends for decades through recessions, wars, and market crashes. SCHD's selection process is designed to capture exactly those types of businesses. That's what gives investors peace of mind, knowing that even when the market shakes, the cash flow doesn't completely dry up. And speaking of peace of mind, one more thing to remember is emotional discipline. When you invest in something like SCHD, you're essentially building a machine that pays you to wait. The hardest part is to keep waiting when everyone else is panicking. During market corrections, the temptation to sell can be strong, but long-term investors understand that income assets work best when you don't interrupt them. There's a famous quote among dividend investors, "Your shares are employees. Don't fire them when business slows down." Each share of SCHD is like a tiny worker earning money for you every quarter. The more shares you own, the more employees you have. Your only job is to keep hiring more by reinvesting and adding over time. Now, before we wrap up this part, let's recap what we've built so far. We've seen how SCHD offers a balance of reliable income and growth potential, how its 2025 numbers translate into roughly 11,600 shares for $1,000 per month, and how risks like volatility and taxes fit into the bigger picture. We also explored how reinvestment, diversification, and time are your best allies in turning those numbers into real financial freedom. So now that we understand how SCHD pays, how the dividend math works, and what kind of risks or long-term assumptions you need to consider, let's move into the most practical part. How do you actually start building your SCHD position and turn it into a reliable passive income machine? First thing you need is access. SCHD trades on the U.S. stock market under the ticker symbol SCHD. You can buy it through pretty much any brokerage in the United States. Platforms like Charles Schwab, Fidelity, Vanguard, Robinhood, or even Webull all allow you to buy SCHD just like you'd buy a regular stock. The minimum amount is simply the price of one share, and since fractional shares are available now on most brokerages, you can even start with a few dollars. Let's say SCHD is trading around $76 a share right now in 2025. You don't need to drop $35,000 right away to get that $1,000 monthly income target we talked about earlier. You can start small, maybe $100 a week, or even $50. The idea is consistency. Every time you add to your SCHD holdings, you're increasing your future cash flow. Once you have shares, the next step is to make sure your dividends are working for you automatically. Most brokers allow something called a DRIP. That's Dividend Reinvestment Plan. With DRIP on, every time SCHD pays a quarterly dividend, that money doesn't just sit idle. It automatically buys you more SCHD shares, even if it's just a fraction of one. That way, your income keeps compounding quietly in the background. Let's say you start with only $1,000 in SCHD. You'll earn a small dividend every quarter, maybe $12 or $13 a year at the current yield. That doesn't sound like much, but here's the magic part. If you keep reinvesting those dividends and keep adding fresh money, it snowballs. Next year, you might be getting dividends on $1,100 or $1,200 instead of $1,000. And as SCHD raises its dividend over time, which it historically has, your yield on cost rises too. Now, one of the best habits you can build as a dividend investor is tracking your income month by month. You don't need any fancy software. A simple spreadsheet works perfectly. Make a column for each month. Note down how many SCHD shares you own, what the quarterly dividend is, and how much that pays you per quarter and per month on average. Watching those numbers rise little by little is incredibly motivating. You'll actually see your money working for you, paying you even while you're sleeping or on vacation. But let's talk a bit about strategy here, because some people ask, should I invest all my money into SCHD? The answer, realistically, is no. SCHD is an excellent core holding for dividend investors, but like any ETF, it's concentrated in certain sectors, mainly value-oriented U.S. companies with strong dividend histories. It's got a lot of exposure to financials, consumer staples, and industrials. That's not a bad thing, but you don't want all your eggs in one basket. That's where diversification comes in. A lot of experienced investors like to pair SCHD with something like VYM, Vanguard High Dividend Yield ETF, or DGRO, iShares Dividend Growth ETF. VYM focuses more on high yield, while DGRO focuses on companies that have been increasing their dividends year after year. When you combine SCHD's balance of quality and yield with DGRO's growth focus, you get a very solid blend of current income and future potential. Another ETF that's often mentioned alongside SCHD is JEPI, JP Morgan Equity Premium Income ETF. It pays monthly instead of quarterly and offers a higher yield, but that higher yield comes from option premiums, not just dividends. So while JEPI can provide more cash flow now, SCHD is usually seen as more stable and tax-efficient over the long run. Now, speaking of taxes, in Part 2 we touched on qualified dividends. SCHD's payouts are usually qualified, meaning they're taxed at lower long-term capital gains rates for U.S. investors, typically between 0 and 20%, depending on your income bracket. That's another reason SCHD remains so popular for passive income. You keep more of what you earn. Let's get into mindset for a second. A lot of people chase quick returns in the market, meme stocks, crypto, short-term trading. But dividend investing, especially with funds like SCHD, is a different game. It's about patience, consistency, and understanding that real wealth builds slowly. You're not gambling. You're owning pieces of real businesses that generate cash every day. When you start looking at investing this way, something changes in how you see money. Instead of thinking, how can I make a quick $1,000? You start thinking, how can I create a system that pays me $1,000 every single month for life? That's where true financial independence starts. And honestly, that's what makes SCHD so special in 2025. It's simple, transparent, and it's proven itself through all kinds of market conditions. Inflation spikes, Fed rate changes, even tech sell-offs. It's not the flashiest ETF, but it quietly keeps doing its job, paying you steady dividends from America's strongest companies. Now let's paint a final picture. Imagine it's a few years from now you've been adding to your SCHD position consistently, reinvesting dividends and ignoring the noise. One day you open your brokerage app and realize your dividends are now covering your electric bill, your groceries, maybe even your rent. That's when it hits you. Your money is officially working for you. You don't need millions to get there. You just need discipline, time, and the right tools. SCHD is one of those tools. It's like planting a tree that gives you shade for the rest of your life. The sooner you plant it, the stronger it grows. And for anyone watching this video wondering whether it's too late, it's not. The best time to start was years ago, but the second best time is today. Even if it's $50 a week, even if it's just one share at a time, you're building something real. You're building ownership, you're building freedom. So as you finish this series, think about your own number. Maybe your goal isn't $1,000 a month. Maybe it's just $200, or maybe it's $2,000. Whatever it is, SCHD can help you get there. Not overnight, but step by step. All you have to do is stay consistent, stay patient, and let time do the heavy lifting. Because in the end, that's how true passive income works. It's not magic, it's math, discipline, and a little bit of belief in the power of compounding. And when those quarterly payouts start rolling in and you realize they're coming from real companies like Pepsi, Coca-Cola, Verizon, and Texas Instruments, that's when you'll know you made the right move. So that's it. That's how you can turn SCHD from just another ticker symbol into your own personal income engine. Whether your goal is an extra $1,000 a month or full financial freedom, it all starts with one simple decision: to invest in your future today. Because if you stay the course, your money won't just grow, it'll start paying you back for life.